Welcome to TheoTrade. This is Don Kaufman. It's February 16th, 2019, and you are watching the TheoTrade Weekend Update. Allow me to begin with a very large announcement here. We have a special guest coming to the TheoTrade live event. That TheoTrade live event is coming to you end of May, early June of 2019. Again, at the end of this video, I will be announcing who that very special guest happens to be. That, of course, will be at the TheoTrade live event. It's theotrade.com/live. With that, let's get into some of the past week's action. More importantly, let's take a look moving forward. Let's begin with the fact that the SPX this week exploded to the upside. I mean, absolutely tore through the expected move. Now, many of you know that I do carry some bearish positions, and one of the things that we're going to cover extensively on this video and on this weekend's update is how we actually deal with this. The fact that the market's exploded to the upside. I happen to be carrying negative deltas. For those of you that do not speak options geek, negative deltas means I'm carrying bearish positions. So one of the big focal points of this weekend's video is we're going to be talking about strategy. We're going to be talking about trade logic extensively when we get into the charts and a couple of option chains. Before we go there, though, let's talk a little bit about the SPX, okay, and the rest of the markets. As I said, the SPX blew through the expected move. The expected move of this past week, and the expected move, again, that's the option marketplace kind of depicting what movement should occur. It's the option marketplace, if you will, kind of handicapping risk to the future. So the option marketplace was expecting a $41 move. Actual move, $70. What does that tell you? And this is something that I've been talking a lot about the last couple of weeks. So we're getting more movement in the actual market. It's called historical volatility. It's the, if you want the definition for historical volatility, it's the annualized standard deviation of past stock price movement. It's actual movement. Okay? The bottom line is actual movement is exceeding, in most cases, implied movement. Implied movement being implied volatility, being, denoting options. So what it really tells me as a trader, you want to be on the buy side of options. And I have been barking about that week in and week out. I don't go through the expected move for nothing. I go through the expected move so that you know, okay, how to position yourself on a week-to-week basis and what we kind of feel implied volatility is likely to do versus historical volatility. And this is critical. I mean, you get a $70 move. Okay, when you're expecting a $41 move, there are almost 2 standard deviations out there. You need to be on the buy side of options. All right. Put that one aside. Again, this coming week, we also have a diminished expected move. When I say this coming week, the week actually that we're going to be kicking off here. Now, the week doesn't kick off, of course, till February 19th. We do have a holiday weekend. Happy President's Day. It just doesn't have really a great ring to it, but happy President's Day. Monday, the equity markets are closed, so we're going to be coming into a 4-day trading week. There's going to be quite a bit of number of data drops. There's going to be FOMC minutes coming up this week. That could be interesting. See the FOMC fighting over what? Over, let's just turn on quantitative easing again. I'm just kidding. But there's about a $34 expected move in this coming week. Now, before I go into that, again, I'll show you that in the charts in a minute. Let's go into the second point that I want to make on this weekend's update, and that has everything to do with data. So there was a bunch of different data drops throughout the course of this week. It meant nothing. If you missed it, the retail sales number came out. The retail sales number, everybody was talking about it kind of midweek. It fell flat on its face, and it caught everybody off guard. But the marketplace, okay, I mean, the S&Ps were up 10, and then the retail sales numbers came out, and the S&Ps were down 10. I mean, they started selling off, and by the end of the day, of course, we rallied back up. The retail sales were so bad that the marketplace didn't even believe them. I mean, that was again, the consensus was, Amazon's doing all right. Again, they were showing in the retail sales that there was a 3.9% drop in a lot of the online sales, but Amazon didn't show that, so the marketplace completely disregarded the retail sales. I love that one. What it says to me, and I'm just going to cut through all of the garbage in the market and all the discussion over there, what it says to me is the marketplace believes, once again, the Fed has got your back. But do they? Does the Fed really have your back? Well, again, we'll talk about that in kind of the coming week, and I'll just give you a quick interpretation of that. The Fed, although they've halted, okay, some of the rate increases, yes, they've halted that. They're still continuing, of course, to diminish that balance sheet as they said that they would. The last point that we're going to make on this video, and then we're going to jump right into it here, is we're going to talk extensively, okay, momentarily about strategy, about trade logic. Because whether you're bullish right now or whether you're bearish, listen, everybody's got a directional bias. I happen to be a bear. Okay, how's that working out? Seeing a rip and rally from the S&Ps, I see them. They've gone from 2,300 and shot straight up to 2,700. Okay, strategy and logic is the only way that you're going to be able to survive that. Now, whether you're bullish, and I'm going to tell you right now, I'm going to show you some strategies if you're going to be bullish in this, because you're looking at this marketplace right now and you're like, it's gone too far, it's gone too fast. You're so intimidated to want to be long. Okay, but at the same time, being short, the more people short, the more we go up. Because the more we go up, the more shorts cover, okay? It's just this horrible, like, feeling like unrelenting, non-reversible cycle. And that's what it feels like. But again, we're going to get into the specifics of this momentarily. Again, strategy and trade logic, it is what will sustain you in this market. Again, stay tuned towards the end of this video for that announcement with a very special guest. With that, let's get to the charts. Let's get to some option chains. To the charts and trades we go. Allow me to begin with a quick recap of a few of the earnings related trades that we did. For those of you that have tuned into these evening videos, if you've been in the TheoTrade chat room, we've discussed two earnings trades this past week, one of them being in Activision, the other one being in NVIDIA. Quick recap of those, both being bullish trades. These were both underlyings that had warned a number of times that they were going to miss their earnings. Okay, they got a tremendous amount of the bad news out, and upon the earnings, bounced back to the upside. Now, in Activision earlier in the week, we talked about in a video, you could have either sold the put spread or bought what is called an in-out call spread. What did we do? Well, I happened to specifically do both of the trades. I sold the put spread because the implied volatility was through the roof. And then I turned around and I additionally bought an in-out call spread. Of course, the stock popped to the upside. By the way, here in Activision and NVIDIA, which we're going to show you momentarily, this in no way, shape, or form is to imply future movement. This is just about an earnings trade. This is about, a company that went out and just guided lower, warned, guided, warned. You knew layoffs were coming. I mean, there was horrific news. So we figured that, the earnings call comes out and it can't possibly be that bad. And the stock pops back to the upside, right? Isn't that the oldest trick in the book from Wall Street? Guide lower and beat those lowered expectations. NVIDIA, the exact same idea. Now, NVIDIA, I just highlighted this in the past Wednesday night video. If you want to take a look back, we put on a bullish in-out spread, and we got just that. Nice pop to the upside. So, again, often, people are kind of cruising through and they're looking for different trade ideas. We're continuously providing trade ideas, whether you're tuning into the evening video, whether you're live in the chat room. Of course, we get into far more detail when we are live in the chat room. With that, let's get to the SPX, because this is what deserves the attention. As I was talking about, this move from, basically 2,300 now into the realm of the 2,700 kind of handle. As I'm highlighting right here, right now, what you're looking at is in this shaded region here, that happens to be the breach of expected move. Again, when I say the breach of expected move, anytime that we are breaching, this upper line, again, this expected move of this previous week, that's $41. That's $41 higher or $41 lower. The breach of an expected move here is substantial, to say the least. Okay, so the breach of the expected move gets highlighted. Why? So that it's very easy in the future then for us kind of gathering data to go back, and you can take a look specifically at all the different breaches of expected move. What we look at the breaches of expected move is a marketplace moving from what we term efficiency to inefficiency. One of the points that I was making just last week was that in almost every single week, of this year, we've actually touched the edge of the expected move. Again, it's critical because we often employ a strategy of butterflies around the edge of the expected move, and those butterflies have been incredibly profitable. If you had the butterfly on this past week, if you closed in on Thursday, you were just golden. If you held it to Friday, on Friday, we had already popped to the upside. There was very little time to be profitable on that butterfly on Friday. Nevertheless, those of you that closed the butterfly on Thursday, okay, it worked, and it worked extremely well. When I look at things like expected move, and I look at things like this explosion, if you will, to the upside of the markets, it is, okay, a little reminiscent, if you will, okay, of kind of the move that we saw in early 2018. Just a relentless, but I'm going to counter with, this has been even more of a relentless move to the upside. And before I go into any details about specific sectors and so forth, one of the things that you're going to have to cope with, okay, from this point on, I mean, you're looking at a marketplace that's effectively rallied from 2350 to, let's just call it 2750 in a matter of a few weeks. Okay, it's astounding, and it almost, if you will, redefines what you know about volatility, because people often talk about volatility, and when they talk about volatility, it's usually because the market is tanking. Well, right now you got volatility to the upside, and in that, okay, lies some big opportunities. Before again, I can go into sectors, and we could talk about the financials, and we could talk about the fact that the monsters of tech lagged the other day. We're talking about that all day, but okay, that's not as important as the strategy and logic that you're going to use moving forward. So let's just hold where we are right there in the expected moves. Let's do that. Let's go right into strategy and logic. For this, I'm going to cruise over to the spiders. So many of you right now, okay, you're looking at a marketplace, and you're distraught in trying to make a decision. And one of the decisions that you're really going to be distraught in making, okay, is, and everybody does this, okay, do you want to be long here, okay, or do you want to be short? Now, some people want to be net neutral. That's okay. I mean, the learning curve is a little higher over there. But if you're net neutral, it often means you're either buying option premium, neutral buying option premium, or selling option premium. And quite frankly, okay, with the implied volatility the way it currently is, I don't think I'm going to be a seller of option premium over here. So if you want to get long right now, you have to kind of fathom that we've just moved this far, this fast. When I talk about long, I am referring to your 401k. I am talking about your IRA. I mean, you look at some of these stocks in here, like, do I really want to go out there and, I don't know, buy a little Facebook over here? Okay. Do I want to buy Caterpillar after the run it's had? Do I want to buy something like Boeing that's hitting at an all-time high, which has been a very painful trade for me, but it's literally at an all-time high? Do I want to own the S&P 500? Okay? Because what I don't want to categorically see people doing is, they get into the party late. Okay? That party has already happened to the upside. They get into the party late. So the first thing that I want to bring to your attention is, if you want to be long this marketplace, when I say long, you want to own some stock. If you want to be long, you better be really smart about how you go about doing that and how we're going to go about doing it. And I'm just going to show you kind of a really very clean, okay, strategy where you do have to trade a little bit. It's not going to be intensive, okay? And I'm going to suggest that you think long and hard about this if you right now want to be long the markets. So we look at the spiders, and the spiders are trading at 277. Okay. We're all aware we can go out and we just buy the spiders, okay? And what's the risk if you go out and buy the spiders? Well, the fact of the matter is, you've seen a marketplace that moves straight up, just like that, okay? If we're going to see some sell-side activity, it could be fast, it could be furious, it could drop us right on our head. And going out and buying this, or for instance, if you have your 401k and you're long a mutual fund, could be a very, very, difficult experience for you. So in light of that, take advantage of the fact that the implied volatility is like extraordinarily low right now, especially in the short duration. So just make an example here. We're only going to go out 6 days. That's it. Why 6 days? I'm going to show you that momentarily, because the implied volatility is next to nothing. When the implied volatility is next to nothing, it allows you to buy, okay, a very high delta dirt cheap. And you're like, what? Yeah, I want to buy a high delta. Again, if you want to be long the markets, So you come in on Tuesday morning, because again, this week, this is a 4-day week. Monday is off. It's Happy President's Day. I'm just not feeling that one. Anyway, go after like an 85 delta or greater. And it's not often, again, on these weekend videos that I get into strategy. Why? because you basically are going to go out there and you'll be able to buy the spiders for $3.78 for how many days? For 4 days. So you're long the markets. How many contracts should I use? I don't know. What do you want to allocate? There's people out there that have, and I want you to think about this for just a second. Okay. Somebody's got a what? A $200,000 401k. Okay. And that $200,000 401k, I like that. The 200k, the 401k. It's a $200,000 401k. And this thing is just, what is it? It's long. What is it long? It's probably a long S&P 500. You're like, no, I own Apple. I own GE. I own GM. I'm like, yeah, you own the S&P 500. Did you know you can go out, okay, with very minimal risk and you just buy an in-the-money call. Now, the in-the-money call has almost no exposure to time value, almost no exposure to volatility. And you can create a similar portfolio with no more than $3.78 at risk. Obviously, that's on a per contract basis. When it's all said and done, though, even if you did 10 contracts, you do realize 10 contracts of this is the equivalency then of what? Okay, with the equivalency, if you will, of 1,000 shares of the spiders. Now, there's some risk obviously in there, right? There's some, $3,700 of risk. Nevertheless, that would simulate being long $270,000 of value in a 401k. And you're substantially only $3.78 of risk. I'm pretty sure you can lose more than $3,700 in your portfolio this next week, even if it is 4 days. What I'm suggesting in here is that you just use an in-the-money call, like an 85 delta, for a long stock replacement. Why? Okay, because we all see the market going like this, and I know that you want to participate to the upside, but if you're going to participate to the upside, you have to be prepared for the fact that, okay, you're very likely to get dropped right on your little melon at some point in the future. You get dropped on your head. It's more important to me that you only lose the $3.78. This could continue a few more weeks. I mean, listen, 28.11 in the S&Ps is an easy thing. Okay, so if we're going to continue to go up, great. And after a week of doing this, what you want to do is just take this option. Okay, if it's in the money, just take the option and roll it. How do you roll it? Okay, all you're going to do at the end of a week is you're going to sell this 6-day option. Then you're going to go out another week, right? What week should I go out to? Just go out to the end of the week. Right? That's all you have to do. I don't want people to kind of overthink this. Just go out again to the next week. In this particular case would be March 1st, and you would exchange it for another 85 delta option. Obviously, these 85 delta options, though, are going to be much more expensive because they have 13 days left, right? So all I want you to do is keep you bullish, but you want to just keep rolling the option week to week. How come I don't go out further in time? Because the further time you go out, the more risk you're going to have to get an 85 delta. You crazy? Why do you want it $14 at risk? Because when we come off this, okay, it ain't going to be pretty. This could last a long time. When we come off of it, though, it could be with a bang. And we could drop like a rock from 278 down to 255 again, overnight. And if you're going to get, caught, you're going to get caught for $3.78. I don't want you getting caught with your pants down and $13, $14 of risk, or even worse, inside of your 401k. That's how you need to get long right now. That's how you need to get long. Now, let me flip the dance card over. What if you're short? Okay, if you're short, you got to be comfortable with your deltas. Now, this is, again, the learning curve is going to get turned up here a little bit for a second. If you're short, okay, short deltas, let's say I'm short, for example, 1,000 deltas, okay, and we'll say that that's SPY delta, right? Basically, I'm short 1,000 shares, okay? There's a few things I can do. Number one, things that I do, I actually go out and I scalp, okay, ES futures on an intraday basis from the long side. I'll actually buy a future. Why? I'll buy a future to offset some of my spider delta. Like yesterday, I mean, I had no clue that we were going to explode like we did yesterday to the upside, but I was long a future, and I was long a few futures contracts, and those futures contracts, they didn't offset all of my negative delta risk, but they offset quite a bit of my negative delta risk. And that's if you just want to be outright, if you're just short the markets. I'm using an ES future on an intraday basis to offset some of the risk. And there's a lot of different ways you could do that. Okay, but it comes down to it. The other thing that I really like to emphasize, and I was emphasizing this, a week or so ago, you can be short by taking what I call short shots. What's a short shot? A short shot is something like going out here and doing a risk twist spread, all right, where I'm selling one of those little monkeys, buying 1, 2, 3 of these, Okay, and here's for $1.41. This is what I call the short shot trade. And I'll just come over here and I'll show you what day stepping looks like. This is a trade where it's not going to really make anything if we just kind of meander down. It's not really going to make anything at all. You're actually going to lose a little bit if we rally. But if we have a huge sell-off, you're going to kill it. And those are the ways to constructively be short right now. Again, if you want to be short, and I do. I look at this run up over here, and if you look at the run up in terms of the spiders, like, come on, it's a Fed fueled fantasy, right? And that's all I can call this rally. It's a Fed fueled fantasy. The Fed, turned 180, but you're going to realize fairly soon the central banks, they may lose a little bit of control, okay, or the element of control. And it's, again, alarming to say the least. Nevertheless, in this Fed-fueled fantasy, I still want to maintain short positions, but you got to be smart by it, okay? You want to be long, you got to be smart about it. Because getting long, all right, you're like, where were you? Where were you 400 points ago in the S&Ps? You're like, no, now I want to get long. Okay, I get it. You got to do this stuff. You got to do it right. The strategy and the logic you use is everything. The last thing I want to show you on here, the XLF. I talked extensively about it on some of the videos this week. Okay, it's right at what we've termed the Maginot line. This is a line in the sand that we've been looking at for 18 months. Okay, it's 2650 in the XLF. Okay, the dynamic of the market really does change when the XLF is above 2650. It's going to happen this next week. I mean, effectively, we closed just shy of 2650. It's going to change the dynamic, and that's why I wanted to bring to you some of the strategy, some of the trade logic, of course, for you to survive, and not only survive, but really thrive in a marketplace that is completely and utterly one-sided. With that, let's talk a little bit about our live event coming up here at the end of May, early June. As promised, a very special guest to be announced. Steve Miller is going to be live at our event. Volatility strikes back right here in Scottsdale, Arizona, end of May, early June. Go through some of the details in just a moment. It's TheoTrade.com/live. Again, TheoTrade.com/live. The entire 2.5-day event. It's only $1,000. Again, it is early bird pricing. Get in now. Again, we've now confirmed that Steve Miller, if you guys don't know Steve Miller, started trading in 1973 in the Chicago Board Options Exchange. Steve has been through it all in this business, and he will take on not only a speaking event, but he will be available for you to discuss with one-on-one some of your trading. And he's also well known of psychology around trading. With that, again, this is early bird pricing. Get in now. We actually have the hotel link up here. It is, again, in Scottsdale, Arizona. We kick off the event with a happy hour live. That is May 30th. As I said, end of May, kind of early June. That's Thursday, May 30th from 7 to 9. It's cocktails and trading. Live sessions to include May 31st and June 1st. All the details of those live sessions, all the different instructors. Again, all 7 of us from TheoTrade are going to now be at this particular event. Here's the entire agenda at a glance. Everything, again, from the happy hour to Friday session. I'm kicking it off. Volatility strikes back. I'm also looking forward to Professor Bierman's session. We're going to have Corey Rosenblum and Tony Rago live together. Matt Williamson will be there. And, of course, our very special guest now, Slim Miller, will be live at this event here in Scottsdale, Arizona. Get in now. We're actually booking out the hotel rooms very, very quickly. Again, it's TheoTrade.com/live. Thanks, everybody, for joining us here on this weekend's update.